So far you have learned that under the aggregate legal concept, a partnership is not a taxable entity. It is instead treated as a conduit through which items of income, deductions, tax credits, and other items flow through to the partners, who report their distributive shares of these items on their tax returns. You have also learned that partnerships measure and report two different types of business income, ordinary income and separately stated items. Each partner is taxed on their share of ordinary income and separately stated items regardless of whether they are distributed. A partner's distributive share of any partnership income item is allocated to them according to the partnership agreement. However, to be respected for tax purposes, the allocations must meet both an economic effect and a substantiality test, as well as consider any pre-contribution gains and losses. These tests and conditions are the focus of this lesson. After learning the concepts, you will apply them to Sunchaser Shakery. The allocation of partnership income to partners is established by the partnership agreement. As a contract governed by state law, the partnership agreement can specify a very wide array of allocations, whatever the partners agree to in most cases. As a result, profits and losses and cash flows are not required to be allocated by reference to a partner's capital ownership, which is often a requirement for most corporations. But, as you have come to expect, partnership allocations have been used by some taxpayers to manipulate the allocation of tax benefits among partners. In other words, some taxpayers have attracted the attention of the IRS by allocating tax benefits purely for tax avoidance rather than economic reasons. Consequently, Treasury regulations now exist to ensure allocations do not undermine federal tax revenues. While these regulations are fairly complex, the main underlying concepts are relatively straightforward. But first, you will notice that the regulations refer to a partner's capital account, which is separate from a partner's outside basis and their partnership interest. Instead, a capital account is a summary of the partner's ownership interest in the entity calculated at the partnership level using any of several permitted methods. The opening balance is the fair market value of the net assets contributed to the partnership, which is increased to reflect income and contributions and decreased to reflect deductions and distributions. But, again, the ending balance of the capital account is rarely the same as the partner's basis. One reason for the discrepancy is that, unlike outside basis, the capital account does not reflect the partner's share of partnership liabilities. To be respected for federal tax purposes, an allocation to a partner must have an economic effect, which is deemed to exist if the allocation satisfies one of three tests. Each test is applied sequentially. Let's call the first test the trifecta. It provides that an economic effect exists if the partnership agreement requires that 1. Partners' capital accounts are properly maintained and thus reflect all contributions, distributions, and allocations. 2. Liquidating distributions are made pursuant to a partner's positive capital account balance. And 3. Partners must restore negative capital account balances if interests are liquidated. Again, if these conditions are met, economic effect of an allocation to a partner exists. The overall purpose is to ensure that a partner receives the economic benefit of an income or gain allocation and bears the economic burden of a loss or deduction allocation. If a partnership meets the first two conditions of the trifecta but does not require partners to restore negative capital account balances upon liquidation, an alternative test can be used to satisfy this third requirement. Essentially, economic effect exists if the partnership agreement includes a qualified income offset provision to make up for the negative capital account. Finally, the third test, called economic effect equivalence, provides that economic effect exists if the partnership allocation achieves the same result as would have been achieved under the conditions of the trifecta without containing the provisions required by the trifecta. In other words, there is room for the partner to argue that the end result of an allocation is economically the same as would have occurred if one had followed the trifecta, a highly subjective situation. In addition to an economic effect, an allocation to a partner must also have a substantial effect. To have a substantial effect, an allocation must have a reasonable possibility of substantially affecting the after-tax economic position of the partner. An allocation is not considered to have a substantial effect if it improves the after-tax economic position of one partner and does not worsen the after-tax economic position of another partner. So, to summarize, for a partner allocation to be respected for federal tax purposes, it must have an economic effect, which is determined by one of three tests, and a substantial effect. Let's now discuss a final concept regarding a partner's distributive share, pre-contribution gain or loss. If property is contributed to a partnership, the difference between its fair market value and adjusted basis at the time of the contribution is the pre-contribution gain or loss. This is the same concept as built-in gain or loss. It just has a different name here. The partnership must track these gains and losses, and any allocation of partnership items related to such property must take the pre-contribution gain or loss into account. For example, if a partnership recognizes a gain or loss on the sale of land, a non-depreciable asset, that was previously contributed by a partner, the pre-contribution portion of the gain or loss, that is the built-in portion at the time of contribution, is allocated to the contributing partner. Things get far more complicated when depreciable assets are involved.